Hey, welcome back to the Advisors Compass. I'm Chuck Downs. I'm here with Andy Schwartz. And each month we sit down and we have the real conversations that advisors are having about growth and scale and clarity. And so if you're ready to grow faster, scale smarter, and build what lasts, then you're in the right place. Andy, how are you?
I'm great, Chuck. How are you?
I'm good. Good
Yeah,
to see you again. Excited
me
for
too.
this one. Although this one is, we've had a little bit of conversation, and so I'm going to take this one slow and try to digest it. But there's a lot going on in the news and just in the industry. I know that some companies have stopped opening new accounts, others have imposed limits, and so something significant is happening around this long short separately managed accounts. And so can you just give us a real big overview of what in the world are these things and what
Yeah.
is it first?
Well, really important for advisors. Okay. For as long as this will last, and it might last forever, it might not, because the government, is, I'm sure, looking at this from a tax avoidance strategy. But this is a major, major interest for high net worth clients, and it is out there. And if clients haven't asked you, they're gonna. So really important just to understand it. So what it is we all understand that a tax loss harvesting, strategy or separately managed account, replicated index is simply individual stocks that are replicating an index, S&P 500, Russell 3000, MSCI World, all long. So traditionally what we've all done in the past is we've used these strategies as long. What's happened now is firms like AQR, firms like Brooklyn, there's a number of firms and many, many more coming. They are now using a similar strategy, replicating an index, but instead of just being long, they're long and they're short. And so that is the difference. The reason for that, and then I'll stop, is that on a long only strategy, eventually you run out of losses to harvest. In a long and short strategy, there's always losses to harvest because no matter what direction the market's going in, there's always losses. And that is basically what's happening here.
So again, I'm going to take it slow for my own benefit
No,
and
it's
maybe
fine.
for some of those that are on the same level as me, slower. And for those of you that are faster, apologize. But how is this different from traditional direct indexing? Because I'm sure
Yeah.
a lot of advisors hear long short and they think, well, this is just a more sophisticated version of something that they already know.
Yeah. So how is it different? So it's different in a couple of different ways. The main difference is instead of just owning the stocks outright, meaning long, what these firms do is they can either take cash from the client or they can actually take existing securities from the client. They use those securities or the cash as collateral, and that cash or security is invested in the index. So if I give them a whole bunch of stocks, they use those stocks to replicate the Russell or the S&P, whatever index we choose. If I give them cash, we deploy that cash, into that index. So that kind of looks just like where we always were, right? I'm in a position, it's long, I'm replicated index. Here's where the twist is. That cash or those equity positions, those stocks that we gave them, act as collateral. So I'm going to make a simple example. Say it's $1 million. $1 million goes into the account. It's in the Russell 3000. That's my collateral. It's also invested in the Russell. So directionally, market's up, I'm up, market's down, I'm down. No magic about the investment strategy. But since they're using that as collateral, what they're doing is they're creating long and short extensions off of that. So in a small example like that, they'd create $45,000, or I'm sorry, 45% or 450,000 of long extension, $450,000 of short extension. So now I got my money invested and I have these long and short extensions. If I have long and short positions or extensions, then that means that no matter what's happening in the market, there's always losses to harvest. But here's what a firm like AQR would say. If you asked, was this strategy simply to mitigate taxes? They would say no, that they have strategies that are, that help you can create alpha for investment and they can prove it and they have for a number of years, which is very important. If you do decide to come into this space and you can come into this space, we think it matters who you choose even, right? And I'm not saying there's only one institution, there's plenty, but you just want to make sure that they have a substantive, evidence of investment alpha creation so that it's not as likely to be shut down. We don't want to just be in a vehicle
Of
that's going
course.
to create losses. So, it's,
I got it.
yeah.
Yeah. Yeah. I guess similarly to, death benefit needs to have a reason, right? To have some
Right.
tax advantages there. So that makes
Yeah.
sense.
Yeah.
So let me ask you this. I know you use this selectively with specific clients. So can you take us inside that decision? So what does the conversation look like when you first bring this to someone,
Yeah.
and what has to be true about their situation before you even go there?
Yeah. So which clients do we talk about this with and which clients do we not? And I would say it's probably about 20%. It's not even close. It's about 20%. Larger clients first. Larger accounts tend to create more tax. So that's important. Clients that have some level of sophistication, some. They don't have to be completely sophisticated, but they have to at least be able to understand the difference between a long, short strategy, what's happening, if it's explained to them. Liquidity matters because whenever you're short, and I think something that's really important as advisors, because at heart, and I don't want to, I'm going to say this, and I don't mean to, it's not a pejorative, but as advisors that are listening, a lot of you are probably very good salespeople and very smart and very thoughtful and good advisors. But in our hearts, we love something new and different. We want to share something that we can help people with. And so I would caution everyone to make sure that they understand how these things work very, very clearly and that they use it at the right time and that the clients understand what's great about it. Because we always love to talk about what's great about something, but we also have to talk about what the problems are with these things. And there are issues, there are things that are different than the normal strategies. Yep. So, but we are having amazing success, Chuck, both with existing clients, getting referrals, to other, clients from these clients. And also, and we'll talk about this, but we're having a lot of success in our center of influence, efforts with this. So
Yeah.
yeah, this is definitely a game changer for us.
I definitely want to cover that. Let's go the other direction. This is a good moment to pause and share something that we've been building. It's called the Playbook for Wealth Advisors. If you've built a successful practice, but you still feel like too much runs through you, then this is for you. The playbook is the framework behind many of the conversations we have on this podcast: how to think like an owner, create real leverage, and grow without sacrificing your time, energy, or relationships. Most advisors don't need more ideas. They need a clear way to structure what they already know. And that's what the playbook provides. You can learn more at epicsuccess.com/playbook. Let's get back to the conversation. Who should not be in
Yeah.
this? Even if they think they want it and they
Yeah.
can access it, who should not be in this?
If you have a $2 million account and they're retired or they're approaching retirement and remember, we need at least, it's $1 million minimum for everybody on the basic, least amount of leverage. So I can't take $1 million of a $2 million account, even though it's going to be so sexy because they're going to get, they could get anywhere from, 10 to 25% a year losses. They'll never pay capital gains tax again. But the problem is whenever you have shorts involved in a strategy, it's not as liquid as if you're all long, forgetting about what the tax consequences are. And so that to me would be completely inappropriate. So if for the people that we would consider this for are longer term investors, if I'm going to put money in this strategy, I like to think of that money as we wouldn't touch that money. We could, but we wouldn't touch that money for 5 years or more. It's longer term investment. It's not shorter term. So that's the first sort of litmus test. It can't be, monies that we would be calling on in the near term. It would be inappropriate. I mean, I would argue equities itself are almost inappropriate, but clearly this would be. And so it's in my mind, the litmus test is it's got to be an account that's got to be aggregately at least $5 million, in aggregate assets. It's got to be, I don't really want to do less than say $3 million of the equity piece that they don't need for the next, 5 years or more. And so that's sort of how we gauge it. With that said, though, if there's adverse tax situations going on, if a client has a large tax bill or something happening, we might consider it more and look at it a little more carefully. if a client has, events coming that are going to create, taxes, a sale of the business, if a client has concentrated stock positions, and we'll talk about specifically why we do that, they will be considerations. But for the normal client without those circumstances, larger, in my mind, 5 million or more, 3 million or more in equities, and longer term on those equities.
So when you read, kind of the some of the downside, right? The critics
Yeah.
say the fees eat up most of the tax savings for a typical investor, and and you'll read where the math just doesn't work unless very specific conditions
Yeah.
are met. It sounds like you would agree that that's a fair criticism.
Yeah. I mean, there are fees, like for example, at a the first level of leverage, with the firm that we work with, the fee is like 89 basis points, give or take. That includes the margin. Now, yeah, it's a lot more than a replicated index. We could do a replicated index for 20 basis points. So you could argue, wow, it's almost 5 times the normal replicated index. But if I can create between a 10 and a 30% a year short-term capital loss, I mean, the alpha on that is amazing. So I would say that the fees, in my mind, aren't really the issue. The issue is the complexity. The issue is the unwinding. The issue is the client's understanding, what they're actually in. The issue is that it depending on the leverage you use, but at the first level of leverage, there's still a 1.5% or so tracking error that has to be explained. That means that the S&P could be up 10 and you might only be up 8.5. And people have to understand that. Now you could also be up 11.5. Just depends on which way the tracking error goes. So, but fees for us, that's not the issue. The tax advantage way outweighs, any additional costs in that index.
Okay.
Yeah.
Okay. One of the other concerns that you'll read about is that this strategy, it just defers the tax problem rather than eliminating it.
Yep.
That eventually the embedded gains I mean, they're going to come home to roost. They have to be
Yeah.
reckoned with. So how do you frame that
Yeah.
reality
So,
with the
so are these taxes being avoided? Are they just being deferred? What's actually happening here? So unlike an exchange program where you can diversify your portfolio in a basket, but ultimately when you liquidate, which you could liquidate those assets, your basis carries forward and you're going to pay the tax. So you're deferring and you're diversifying. So good strategy. I'm not being critical of that. This strategy, if I take highly concentrated stocks and I put this into a position, I can get rid of and diversify that position, technically I get rid of the taxes on that portion. Now, what's happening though is if I'm in this strategy 10 years, obviously the market's going to hopefully double, and I'm going to owe taxes, on all that. So it's not as though I'm going to, have losses every year. It's going to mitigate every gain I have. That's not going to happen. But if I'm using that strategy to eliminate an initial capital gain, if you will, on a sale of a business, or if I'm using it for concentrated risk, I would argue I'm getting rid of those taxes or whatever that portion is. But the gains over time, because the market presumably will go up, there will ultimately be capital gains taxes. Now, if I'm older and I die with those assets, people have to be careful because there's issues about step up and basis. But at the end of the day, it's not a tax-free strategy forever, but you are getting real tax advantages up front that you're not necessarily paying for later.
Got it. Got it. Why don't we jump over to something that you mentioned and alluded to earlier? You see this as an opportunity to deepen relationships with CPAs, with tax professionals. So walk us through what that conversation sounds like
Yeah,
that you're having, and what does the CPA need to hear to become a
yeah,
genuine partner rather than only a referral source?
yeah. So what are we doing with CPAs with this? I have a call today with two partners in a CPA firm. As a matter of fact, it's 11 o'clock this morning. That'll be one of my calls today. I want to talk to every accountant that I've ever been introduced to that works with any of my clients. And the conversation is something like this. So Chuck, first, there's something happening in the marketplace that your clients, if they haven't already started coming to you, they're going to. And so what I'd like to do is I'd like to at least help you explain how this works, what it is, so that you can, be prepared for these questions, right? Because, you don't want to get caught off guard. So that's my first thought. I want to be a resource and help you with that. But second, Chuck, and this is going to sound a little hokey, but it's really hard to be an accountant today, especially if you're working with wealthy people, because there's nowhere to hide. And all you do is you're the guy that tells them that you got to pay $200,000 a quarter, in quarterly, tax payments. And they're like, you're out of your mind and I hate you. And then it seems to us like people always complain to us about their accountants. And I'm always saying, look, it's not their fault. There's very little that they can do today. Well, everybody likes to be a hero. Chuck, I'd like to try to help you be a hero here. I'm not saying this is going to work for every client you have, but I think that we have a strategy that would be something that you could go to clients with, and they would actually feel like, wow, my accountant, is helping me with what I really want help with, and that is to reduce my tax liability. And there's a couple of other strategies that we use as well. So that's my conversation. And then we go through, we give them the examples of how it works. We give them the deck. And then I tell them, look, this is complicated. I want to have this conversation again. And again, I want to teach them. I might have 3 or 4 conversations with them, and then I explain to them who we're looking for. You've got clients that are going to be selling businesses the next 3 or 4 years. We want to talk to them. Or even if it's next year, you want to talk to them. We want to explain how we can help them with that. Everybody's got clients. You have clients with these highly concentrated stock positions. They bought Apple, God bless them, $50,000 investment, 10, 12 years ago. It's now worth $4 million, and it's completely offside and it's completely over concentrated for their portfolios. We can help them. And so we want to basically educate them. And to me, I want to, and I want to talk to as many of them as I can. We've got lots of clients. We're always talking to their accountants, with the tax information, my offices. I said, okay, let's get a list of all the accountants that call us during the year. Let's reach out. We have something that we want to share. And so we're very excited about that opportunity.
How new is this? How long has this been
Yeah.
around, and why is it gaining?
Yeah. It was an institutional trade. So how long has this been going on? Institutionally for a number of years. What AQR does is they have 2 strategies they've been running for literally decades that they combined into this strategy. And it's been going on for a couple of years now. So it's not brand new, but it is new. It was more of an institutional trade. And now what's happening is the retail side, of the market, is starting to get involved in this trade. And I would say, we've been looking at this for the last 12 months. We started to really implement this about 6 months ago. So we're not necessarily early, movers, but we're probably in the first, 10 or 20%, of the movers. Again, there's minimums. Some broker dealer or some custodians are at a $5 million minimum. Some are at a $10 million minimum on the actual investment. Clearly $1 million minimum is going to be on any of the platforms that we're operate on. And if you want second degree of leverage, it's 3 million. So these are not small trades. But there is track record here, and there's a significant track record for some firms, with the strategies. But it's much more pro forma because they were 2 combined strategies. But these are, again, very, very interesting. Look, I use them myself. I've got a tax issue like all of my biggest clients do, and tax friction, is a big deal.
So this is something that's been widely used in institutional investing for a long time, at least for a while. And now it's just trickled its way down to the retail investor is what it sounds like. And I would assume that this is just going to continue to gain momentum.
Yeah. And unfortunately, I hope it doesn't gain so much momentum, that it actually becomes an issue, from a tax standpoint for the government. We'll see. But the fundamental premise, it's just losses. Losses are losses, so we'll see. I do tell my clients when clients ask, okay, so what's the downside? We talk about liquidity, for sure, because that's really important. But the downside is, look, it could be taken away in the future. And if it is, we'll have to unwind it. We'll have gotten the losses we got, and then we'll have to, we'll figure out where to go from there. Maybe go back to our, original, long only strategies. But we want to make sure that people understand that as well.
So liquidity, potentially this could go away. Any other downsides that you see?
Yeah, just complexity. Let's say you're using a second degree of leverage. You used to be able to do a 3 degree of leverage. Everyone's pretty much taken that away. At a second degree of leverage, your tracking error is now more like 4.5%. And that's an irregular standard deviation of one, just a regular market. So this year, I mean, although nothing's regular about this year, but let's just say this year so far is still a regular market. We're chopping around, it's up a bit. But let's say you got into a 2008 market, where you could be 3 standard deviations away, where, something, crazy is happening. Then now all of a sudden you could have a 1,200 basis point, differential, tracking error, if you will. And people have to understand that, like, hey, the Russell's up, 5% and I'm down, 5%. Well, yeah, it was a very unusual market. There's a big tracking error. Now it could have gone the other way. These institutions will argue that they're going to help you and that their long shorts are better and all that. We just ignore that. To us, that's just noise. So they have to understand there is tracking error depending on the amount of leverage that's put on, to the trade. And complexity is an issue. I mean, we always hate people to do things they don't understand. So you want to make sure that you take your time if you are presenting these things, that clients really understand how these things work. I mean, they don't have to, they at least be able to tell the time. We always say they don't necessarily have to be able to build the watch, but they got to at least be able to tell time. And so we want to make sure that we take our time, we explain, the issues. We'll get on with it, with the institutions, if clients want to, where we're having tremendous success, the financial, community, obviously, because they're much more familiar,
Right.
And not only that, they all know each other. They know the people that we're bringing them to. They're like, yeah, we would like to have those people, manage some assets for us.
So you're saying like the private equity guys, the hedge fund guys, the guys that are running money or doing deals, they're hot prospects for them.
Well, because because they're somewhat familiar. The other problem, if you will, or complexity is that you can't own individual securities away from this strategy. And that is actually a pretty big issue as well. So let's say someone has 5 different, advisors, or they have 5 different accounts, or they like to trade accounts, their own accounts. That's a problem because we can't give individual stocks to the institution, have them long and short in their strategy, and then have those stocks being owned long somewhere else. That's a tax issue and it can be penalties. And so the one thing that people have to understand is what are the rules? And the rules are you can own ETFs, you can own mutual funds, you can own lots of other things, but you cannot own individual stocks in a separately managed account or otherwise and have this strategy on the side. It has to be coordinated. And so there are times like I was with a client last night and it would be a great strategy for them, but I know she's not giving up, her day trading. She's just not going to do it. And so that's okay. It's not for her, it's not for them.
So it sounds like that's an opportunity then for some clients, the right client, to maybe consolidate into one advisor if they've been spread out.
It's a very interesting opportunity to do what we call gaining wallet share. It absolutely is. Yeah, it's a very good opportunity, for us to be able to clean up. And it's also a good opportunity where you've got clients that are doing this, and I'll have another one of those conversations tomorrow, where they think that they know what they're doing, but they don't. But they bought some tech stocks and they've done fine. It's a good opportunity for them to kind of give up the day trading and just go back to their normal job.
Right.
Yeah. But if they don't want to, it's fine. If they don't want to, it's fine. It doesn't. It's look. We just want to be able to offer solutions that are out there that are good solutions, and help them, find things that, are good, planning strategies, tax strategies. Whether they do it or not, it's completely up to them. We don't really care. It doesn't really matter to us. If it works, it works for them. If it doesn't, it doesn't. I just don't want to be, I don't want someone coming to me and asking me why I didn't show it to them. That's always my fear.
Right.
I just want to make sure I might, here it is, might or might not make sense. You might or might not want to do this. We think it's interesting. I wanted you to be aware.
Right.
I wanted you to be aware.
Right. Before I ask the last question, anything that I should have asked you that I didn't, or anything else that you think our listeners might be thinking that they would love to hear you address at this point?
No, there's no, I think we've covered most of it, but there are very, very unique, specific marketing opportunities. I mean, I've got a partner in Minneapolis, very smart. They do a lot of work and the business owner getting ready to go to market to sell businesses. And there's always bankers involved. So for him, he's talking to bankers. I'm talking to accountants, right? Because I think that the accountants are, this is taxes. So for me, it's accountants. But when we think about concentrated stock positions, when we think about people selling businesses, just the normal people hate to pay taxes, okay, that's fine, but not as powerful. But for the other two, constituencies, very, very powerful. Again, my 1 o'clock today, huge NVIDIA position, lots and lots of other positions. And people want to be able to diversify. This is a great way to be able to diversify without having to pay the tax.
Right.
So, yeah. So no, but I
Right.
would say otherwise, we covered it, I think. Complicated, it's not for everyone. People shouldn't get overly distracted about this. I think if nothing else, I just want advisors to understand it. And if your broker dealer doesn't allow you to do it, it's fine, but you need to understand it so that, when the questions come, you have a way of at least explaining to the clients, why you don't think they should do it.
Right.
At least you got to at least understand it. Yeah.
Right, right. Well, and why don't let's speak to that. This will be the last question for the advisor listening who's never going to have a client that qualifies for this strategy. What's the shift in thinking that this conversation maybe should create for them?
Yeah. This is a great entree to talk to people. If you have no one that qualifies for this, then you need bigger clients. Because we have lots of clients that qualify for this. This is a great way to cultivate some of those clients. My partner, Mike Axelrod, always likes to say, like, this is a referable moment. You know, um, it's like, people talking about what they think about the market. I did a podcast a couple of weeks ago and I said, well, okay, well, what do you want to talk about? And they said, oh, the markets. And I said, who's listening? And they said, oh, advisors. Like, nobody wants to hear me talk about the markets. I mean, the last thing an advisor wants to do is listen to me talk about markets. I mean, it's ridiculous. This is something that you can use as a tool to get interest, from, larger clients that you really want to have, so to me, that's what we're excited about. We just think we've got to, and it's been working, it's a real referable moment. It's an access to, for us to go up markets with something that people are not aware of or are not using.
Right. Yeah.
At least, and won't last forever because everybody will figure it out eventually. But for right now, it still seems to be something that when we talk to clients about, they're unaware.
Well, it seems like this is one of those moments where it's something rare that's unique that is valuable in certain situations, and opportunities like that don't come along very often, right?
Yeah, I would say, I'm trying to even think of the last time, I've been doing this for a long time, that I felt like I had something that was unique. I mean, look, 10 years ago, we were doing replicated, indexes. That was kind of cool, where we were, it was parametric and it was sawtooth and we've been running our own for a number of years, but, that was sort of different, where you meet people that are in mutual funds and you could talk about how we can do that more efficiently and more tax efficiently. And I think that was somewhat of a referable moment. If nothing else, it was a way to grab assets. This is that on steroids. Yeah.
Yeah. Yeah. I mean, the opportunity, from what you've said and what I've, read about a little bit, the opportunity to bring significant new value to the right person, it just doesn't happen very often. So this sounds like one of those times.
Yeah, we're excited about it. And we're really excited about going to our centers of influence. Because we've always talked about, it's great to go out and prospect and find clients yourself. Wouldn't it be even better if you could have 20 or 30 people out there looking for you? So that's just great leverage. So yeah, so we're
Yeah.
excited,
Yeah.
what might happen with this. Yeah.
Well, I appreciate you taking the time to share this. It was good. It was insightful. I enjoyed it. And to our listeners, thanks for joining us on the Advisor's Compass. And we would hope that if today's conversation gave you clarity or it sparked a new idea, subscribe so you never miss what's next. And also share it with another advisor who you think would benefit, because when we can help you grow faster, scale smarter, and build what lasts, you're able to create clarity every step of the way and make a bigger impact in those people that you get the privilege of being a steward for their future. So thanks for being here. We'll see you next time. Andy, thanks.
Oh, my pleasure, Chuck. Good seeing you.
Good seeing you. Be well, everyone.
Herein referred to as 1 Point BFG. 1 Point BFG is not affiliated with Advisor Compass. Chuck Downs is not affiliated with 1 Point BFG, nor compensated by 1 Point BFG. The opinions expressed by Andy Schwartz are my own personal views and experiences as an investment advisor representative. The information contained herein is provided for informational and discussion purposes only and is not and may not be relied on in any manner as legal, tax, accounting, or regulatory advice, nor does it constitute an offer to sell or solicitation of an offer to buy any securities, and may not be used or relied upon in connection with any offer or sale of securities. The information, as set forth herein, should not be construed or interpreted as One Point BFG's guarantee of any particular investment outcome or guarantee of future investment returns or results.